These are unprecedented times that we're living in. And as far as I'm concerned, what's happening in the stock market right now is very concerning. And unfortunately, things are only going to get worse before they get better. Between the historic Russian-Ukraine invasion, the federal government set to increase interest rates very soon and potentially 9 more times this year to fight blazing hot inflation, investors freaking out because the S&P 500 just had its first correction in 2 years, and a lot of other chaos happening in the world, it's going to be absolutely critical that you know exactly what to do next to protect yourself, your family, and your finances from utter disaster. First things first, the Russian-Ukraine invasion. So Russian troops have officially entered Ukraine and launched their first official attacks, a devastating move that has caused markets around the world to plummet. For starters, Russian stocks have plunged to record lows, with Moscow's MOAX stock index now down over 45% from its highs. And of course, this has a direct effect on every major global market, especially the US stock market. Because the US has promised sanctions against Russia and have officially began implementing those sanctions, investors are already panicking. You see, the problem with all of this is that Russia just so happens to be the largest producer of oil in the world. And surprisingly, Russia is the second largest exporter of oil to the US. And so, of course, naturally, US sanctions against Russia are going to have a direct effect on the prices of oil, and it's already beginning to happen. After Russia's recent attack, the price of oil per barrel has jumped to over $100 per barrel. And as I've illustrated on the screen here, the price per barrel has a direct effect on the prices that you're paying at the pump for a gallon of gas. Now, JP Morgan has warned that if Russian oil exports are disrupted by further conflict, oil prices could easily jump to $120 per barrel and potentially even $150 per barrel, driving up gas prices even more. And to make matters even worse, rising oil prices are going to have a massive negative impact on inflation within the US. The current inflation rate at the time of making this video is 7.5%, the highest since 1982. But rising oil prices would translate into higher heating and electricity costs. And higher heating and electricity costs would make it more expensive for businesses to economically transport goods from point A to point B, which adds even more pressure to businesses that are under strain because of the supply chain crisis. And so, of course, to offset operational costs, businesses are likely going to pass along their expenses to you and I, the consumer, in the form of higher prices on goods and services. And this is coming at a time where inflation is at a record high and will only get worse until the Fed begins raising interest rates. But once the Fed begins raising interest rates, the stock market is going to go down even more. So it seems like we're just in this downward spiral that has no end in sight. And besides oil, let's not even begin to talk about how Russia is also the biggest exporter of wheat and a major producer of metals. And although the US doesn't get any wheat from Russia because we produce almost all of our own wheat, minus the tiny amount of wheat that we get from our friends over in Canada, shout out Canada, many major economies still rely on Russia for this supply. And because we live in a global economy where the effects of one country's economy can be felt around the world, this wheat issue is serious. And I also suspect that Wheaties are gonna get a lot more expensive moving forward too. So invest in Wheaties, they're going up, going to the moon, Wheaties. But what the US does rely on Russia for is this small little tiny unknown metal known as palladium. Palladium is used in car catalytic converters, mobile phones, and even dental fillings. Palladium is the fastest growing precious metal in recent history, rising from about $190 per ounce back in 2009 to almost $3,000 per ounce today. Needless to say, Russia happens to be the largest exporter of this metal, and because of the rising tensions, the cost of this metal has skyrocketed 25% and will likely continue getting worse. This will of course directly impact the cost of things like cars and phones, jewelry, and even dental procedures. And during a time where every major global economy in the world is facing huge pressure because of the global supply chain crisis, the last thing any of us needs is further disruption to add more fuel to the fire. And so this is just part of the reason why the market just cannot seem to find a bottom. Another major cause of concern is still inflation, but even more specifically how my good friend Jerome Powell is going to handle the situation. So Jerome, we are quickly approaching the first interest rate increase of the year. What exactly are your plans for, say, future interest rate increases? Well, here's the thing. I plan on completely obliterating your stock portfolios. Yeah, my goal as chair of the Federal Reserve is to destroy the stock market so that me and my good friend Nancy can dip in and buy stocks while those suckers are cheaper than a gas station burrito.
Yes, baby. You got that right, Jerome. Hee.
Because of the constant pressure from all of the chaos happening around the world, inflation is quickly getting worse, and the Federal Reserve is already behind the curve, and they know this. Now, Jerome Powell has not explicitly said how many times they actually plan on increasing interest rates this year, but JP Morgan has reason to believe, for some reason, that the Federal Reserve will raise interest rates 9 straight meetings in a row. And this, of course, poses a major threat to the market because rising interest rates almost always have a negative impact on on the stock market. When interest rates rise, stock prices fall. I told you I was gonna destroy your stock portfolios. I warned you, you didn't listen. The Federal Reserve is set to start increasing interest rates as soon as next month, as they attempt to fight the country's worst inflation in 40 years. Something else that we really need to address is the fact that the S&P 500, one of the world's largest stock market indexes, has hit a 2-year low. And honestly, with the way things are going, it's probably gonna get worse. For starters, the market is technically already in a proper correction. A correction is defined by a decline of more than 10% from the highs, but less than 20%. And as you can see on the screen here, from the highs at the beginning of the year, we are down well over 10% at this point. Frankly, at this point, I'm sort of anticipating a full-on crash before we then reverse and start setting sail for new highs. I think Jeremy Grantham, who is predicting that the S&P 500 will crash 43%, is getting very excited at this point. Now, with all of this chaos going on, the market's literally giving no indication of turning around anytime soon. What should you do? Should you sell your stocks and ETFs like some investors are doing? Should you use this as a buying opportunity to buy more stocks and ETFs while they're cheaper? Or should you just shrug all of this off, pretend like the world is fine, everyone is at peace, and Jerome and Nancy will live happily ever after? Well, first, I want to put something into perspective here. I think what you're about to see will help you make your decision on what your next step should be. Let's travel back in time to February 27th, 2020, a time that all of us are probably very familiar with. This was the infamous day that the Dow plunged 1,100 points. This was also the beginning of the COVID-19 pandemic, one of the 7 deadliest plagues in history. Around this same time, there was the potential for a full-blown war. With escalating tensions between Moscow and Kiev, inflation in the US surging, and fears of the coronavirus outbreak being drastically higher than they are today, there was a lot happening during this period. And as you can see, the stock market responded accordingly, shedding nearly 32% of its gains in just under a month. Is the same thing happening right now? Is the stock market gonna drop another 20% from its current point? Yes. No, I'm just kidding. Nobody actually knows. But what we do know is that history suggests that the market tends to bounce back after a broad market sell-off, with data backdated to 1928. Out of the past 20 corrections that have occurred in the S&P 500, including those that have turned into bear markets, 70% of those ended up higher. Now, you may be thinking to yourself right now, Joshua, of course, if the market only goes up over the long term, then this makes sense. But does it? Do all investors respond to this chaos with a calm, cool, collect demeanor? Probably not. Although, yes, past performance is not a guarantee of future results, and of course, this is not financial advice. There, are you happy? History has a funny tendency of repeating itself. Not 100% of the time, but a lot of the time. But where many investors go wrong is that they forget that investing over a long period of time, using a diversified portfolio of low-cost index funds or ETFs, is the best way to build wealth long-term. And so what a lot of investors will do is panic sell during a time of uncertainty like we're experiencing now. Now, if 50% of my portfolio was invested into Facebook, then yes, I would be panic selling right now.
Well, in a nutshell, I would say it is a buying opportunity.
But fortunately, many of us, and I hope that you're one of them, have a diversified portfolio that is ready to weather these storms. And so with that, what should you do next? Well, Tom Lee of Fundstrat thinks that any panic around Russia and Ukraine will be short-lived. And so you shouldn't go out and just panic sell all of your stocks and ETFs, but instead just sit and watch this play out. Exactly like we saw in 2020 with the Moscow-Kiev tensions, markets have a tendency to fall during the run-up to an invasion. And so Russia is invading Ukraine right now, and the markets are responding. We can see that correlation here. But then what tends to happen is the markets rally, as in they go up, when the actual events happen. Now, these things play out on an hour-by-hour basis, and so I could post this video and the markets could drop 40%. Like, nobody actually knows what's gonna happen. But this unpredictableness is exactly why you should just remain calm and not try to time the market. Just hold your position, and if you feel like you want a dollar cost average into your position even more, as in buy the dip, then go for it. Even if you don't get lucky and buy the bottom, and after you buy more, the stock market continues crashing. So what? You are investing for the long run, so who cares what's happening right now in the short term? Buy more stocks. Who cares? You'll be fine. I mean, that's what I'm doing at least. This isn't financial advice. I'm sorry. That's all I've got for you guys in today's video. If you have not already dropped a like down below for the YT algo, please do that. Also, subscribe to the channel if you have not done so, but you like content like this. Also, remember to follow me on Instagram at @RealJoshuaMayo. You guys are amazing, and as always, I will see you again very soon. Take care.